Goldman, my favorite prime broker on the planet, the smartest people on Wall Street. And what is Goldman saying? Goldman is saying that um, the first of all, as we know, since last October when the market bottomed, the S&P 500 is up 40%. 40. The usual return on the S&P 500 is only 10% a year, 9 to 10% a year. Well, in 1 year we did 40. So Goldman says, now could be right, could be wrong, but I wouldn't question Goldman too much. Goldman predicts 3% return for S&P 500 over the next decade. 3%. So I've been telling you guys, DCA, dollar cost average, do this, do that. Well, if you're going to get 3%, it may not be worth it. So there may be some strategy change here. But again, nobody knows what's going to happen. I still say dollar cost average. I still say it's never too late to invest. And stock concentration and high valuations could limit S&P 500 growth, warns Goldman. However, to rebut this argument, I'm looking at the S&P 500's earnings next year. They're supposed to grow 25% from 215 to 275. If that happens, you're still going to get your 10% minimum return on the S&P 500. Although this 40% that we jumped in 1 year makes no sense. And then I talked about all households being all in, right? The rug pull is near, almost like it looked like a rug pull on Wednesday. But then we're right back to new highs. So I'm not concerned. So that's what Goldman is saying. And, Goldman is king on Wall Street. I'm telling you, Goldman's bearish outlook. I mean, it's not bearish. You're still going to get some return, but nothing like, 40% obviously in 1 year. Goldman's bearish outlook comes as the S&P 500 enters its third year of a bull market with 27% annual total return over the last 2 years. That includes the downside that we took. But since last October, when the market bottomed, we're up 40% on the S&P 500. So Goldman is saying after this kind of performance, right, if you caught it, great, but don't expect. I mean, this is not bearish. It's saying don't expect, the market to give you 40% year after year, specifically on the ETF side, which is the S&P 500. According to Goldman, this high level of equity valuations is a major factor behind their low 10-year return forecast. Okay. Their model predicts annual returns ranging from plus 7% to negative 1% with a 72% probability that stocks will underperform bonds over the next decade. That one we're kind of disagreeing because, the bonds have done nothing but go down. Actually, interest rates have done nothing but go up since Fed started lowering the rates and started their next leg of QE, quantitative easing. I think the Fed has lost the control of the bond market as far as I'm concerned, because it was the first time in my lifetime and career that I remember Fed said, we're going to lower rates. And the bond market said, no, we're not buying any of that story. First of all, the bond market is too big even for the Fed to regulate. Rates have been shooting up. Mortgages are right back to 7% again on 30 years. Something is happening here. If you look at this bigger picture, people, gold is making all-time new highs. Silver is making all-time new highs. Bitcoin is about to make all-time new highs. Stock market is at a new high. Real estate is at a new high. While the Fed is cutting rates. What's happening here? I'm not sure. Right? That's why you guys need to go watch that Bitcoin interview with Sonny, because he said clearly, I'll give you one tidbit. He said they cannot afford this thing to go down. They just cannot. Because half the tax receipts that go into the treasury are from stock sales, are from capital gains of selling of all asset classes. So gold is saying, no, inflation is not dead. Silver is saying that. Bitcoin is saying that. The stock market is saying that. Everything is saying, Fed, you're wrong. But Fed goes, no, we're just going to keep cutting rates. Does that mean they're going to add more fuel to the fire? Possibly. We'll find out. This is a fantastic time to be in financial markets, actually. So many cross currents going on that I'm loving it.